It's no secret that Warren Buffett is one of the best investors that ever existed. But not a lot of people actually know that options make for part of the strategy that Warren Buffett uses to generate income and to also buy other companies. So today we're going to be looking at two instances where Buffett used options. We're going to analyze the outcomes and how these options made him more profitable than he was before. So let's jump right into it. So by now you know that Warren Buffett likes his Coca-Cola and his McDonald's, but Coca-Cola and him go way, way back. Back in 1993, Buffett made a strategic move with options that made him $7.5 million in a single trade. Of course, $7 million for a billionaire is not a lot of money. We know now that Buffett's net worth is over $200 billion. It's way above the $100 billion in cash value. Of course, this fluctuates, but back in 93, his net worth was just $8 billion. But even so, $7.5 million is not a lot of money when you compare to the amount, the network that he had already. But for us measly mortals, $7.5 million is a lot of money. So let's see how he made this money. So in 93, he shorted, so he sold puts. He sold 30,000 puts of Coca-Cola for a $35 strike, meaning that if Coca-Cola stayed above the $35 per share, he would keep all that premium. And here, two outcomes could have become true. He just kept the premium and the option expired worthless, or he kept the premium, but he had the obligation to buy Coca-Cola at 35 bucks. For him, it made sense because again, he loves Coca-Cola. He always liked Coca-Cola. So having more stock of Coca-Cola at a price of 35 per share was good for him. So that's what he did. He sold 30K contracts for December 17th. So 1 month out from when he opened this position. So let's go over the specifics of this trade. The strike price was 35 bucks per share. The expiration date, as I said, it was December 17 of 1993. I wasn't even born yet. The premium that he collected was of 7.5 million in cash upfront for selling these puts. And here the specifics are: if the Coca-Cola stock price remained above 35, the option would expire worthless and Buffett would keep the entire premium. So the whole $7.5 million would be his to do whatever he wanted with. If the stock fell below the 35, he would be obligated to buy the stock at the $35 price. And given that he received $1.5 per share, his effective price would be actually 33.5 per share. He would have indeed to pay 35, but because he already collected 7.5 million, that would lower his entry price to around 33.5 per share. So what was the outcome? Well, Coca-Cola never went below the 35. So he kept the premium. But throughout the trade, he was always open to buy Coca-Cola at 35. Why? Because it is something that he wanted to. He wanted Coca-Cola in his portfolio, or he wanted more Coca-Cola shares in his portfolio. And what does this option teaches us? Well, it teaches us two things: that you can sell puts to make income, but you can sell puts also to get a better entry price. So instead of buying Coca-Cola at the current price that it was when he opened the position, maybe Coca-Cola was at 40, he collected premium, so he made pretty much free money. And in case Coca-Cola actually went below 35, he was gonna buy these shares and he would have a good entry price, because again, it was 40 at the time that he opened the position, and now he was getting in at 33.5 because of the discount that he got from the premium that he collected. So he saw an opportunity for generating income, for lower entry, and a good risk reward ratio. Again, this wasn't the only time that he did this. So let's say he did that for November to December. Then the option expired worthless. Then he did that from December to January and also expired worthless. So you can see that now he has $15 million collected in 2 months. Is he said that he did not own these shares of Coca-Cola? Well, maybe he's a little bit bummed because he didn't get to buy more Coca-Cola, but he's very, very happy because he's making a lot of premium. He's making passive income. Month by month, he's just collecting that cash back into his wallet. Let's look at another example on how he used options, and he actually got assigned, but it was part of his plan, and he actually used that as a strategic acquisition of Burlington Northern Santa Fe with ticker BNSF. So the actual values for these trades are not public, but we can also assume that it was multiple millions of dollars involved in this trade because it was an acquisition of the whole company itself. This happened in 2008, and he did the same thing as to Coca-Cola. He sold put options on BNSF. This gave him the obligation to buy shares of BNSF at a specific time in the future for a specific price. So he receives premium upfront, giving him cash flow, which is always good to have. And the strike that he chose was a comfortable strike for him to enter the position. So this is what he did. He sold these options. What was the intent? What was the intent behind this trade? It was to acquire these shares. He wanted these shares. So it was a way for him to get in, collect some cash, to have cash flow, and also to get a better price. And in case this didn't happen, he would just collect premium, which is free cash flow, and then he would do that all over again on the next month and wait until the option got assigned. So what was the outcome? The outcome was exactly this. This strategy facilitated Berkshire Hathaway acquisition of BNSF because it allowed Buffett to secure a large quantity of these shares for a favorable price. All of this, meanwhile, he was generating income. Cash flow is always good to have on the reports because you have cash in hand in case there's something bad happening with the market. Overall, it was a flawless execution from him, and the acquisition of BNSF turned out to be a very, very profitable investment for Berkshire Hathaway. And this proves the use case scenario that options have to benefit better entries, lower prices, and also passive income, as we saw here before. Because he believed in the long-term value of this company, he used these options to acquire, I think it was around 20%. I don't have the exact numbers, but with this strategy, he bought 20% of the company by selling these puts and then having to buy the asset at a specific price. But then ultimately, because of this huge share that he now owned of the company, he agreed to buy the remaining 77.4%, which was publicly of BNSF, for $100 per share. So he bought another 77%, making Berkshire Hathaway the full owner of BNSF for around $100 per share. And this transaction was overall $44 billion in cash. And this was a significant bet for the future of railroad system in the US and also for Berkshire Hathaway. So these were just two of the many stories that we have from Buffett and also other major traders. And this can also be applied for crypto options. You can use options to generate income, and that income can be free cash flow that you can use to buy your crypto at a cheaper price than it currently is. Because if you want to buy this asset at $50, but you just made $5 for free, you're only going to put out of your pocket $45 because these 5 are not expenses, didn't come out of your pocket. So you put 45, you add the 5 that you just collected as premium, and then you can buy the asset at 50. So premiums are great for lower entry, and they're also great for lower the average price of something that you already own. Because let's say you have a Bitcoin, or let's say you have Ethereum, and you sell calls on top of it, and you never get assigned, meaning that you always get to keep that Ethereum, you always get to keep that Bitcoin. It will be, all the premium is going to lower your average cost, your average price of the asset, because it is free money that you can deduct from the average price that you paid for it. And you can say, Everton, how can I make income with this? How can I generate income with crypto options? Well, you just go to bitopics.io, which is the first link in the description. And the easiest, simplest way that you can do this is by using spreads. You don't have to know how to open a spread because we make it simple. You just head over to the Earn tab right here, and you see these cards right here with expiration dates on top of them. What do these cards mean? Well, if you analyze, you can see how simple this strategy actually is. Let's take, for example, July 19th as the strike for our option. Here we have 2 for Bitcoin and 2 for Ethereum. Let's take a look at all of these. You see the target price, you see the maximum profit, and you see the risk. The target price, it can be above a certain number or below a certain number. So let's analyze this first one right here, above $55,000. If you believe Bitcoin by July 19th will be above 55K, this strategy will pay out 11% ROI if it actually comes true. If it is 5501 or if it is 59,000, you still made money. You still made 11%. So your maximum profit is capped at 11.1%, but you don't need to know a specific price. As long as it is above $55,000, you made that 11%, meaning that if you put $100, you made $11 in profit. So you get your collateral back of $100 plus the 11 that you just made in profit. But let's say on the opposite, you believe it will fall below $53,000. Well, guess what? Now you just tripled your money. You made 232% maximum profit. So if it is 52,000, or if it is 49,000, if it is 52 and a half, you just made 232%, meaning that if you put 100 bucks, you're going to get out the 100 bucks in collateral plus 232 in profit. So now you have $332. And for Ethereum, same thing, it just changes the underlying asset. So 10.9% if you believe is going to be above 2,900, or 240% ROI if you believe it will stay below 2,800. Of course, you can see the prices of these assets on the top right there, 57,800 and 3,100. So for these two strategies that are paying over 200%, we're now looking at a very risky, because the underlying asset would have to fall a lot to stay below these prices. And for the ones that are paying around 10%, these are not very risky, because the lower the risk, the lower the returns, the higher the risk, the higher the returns. So you can see how easy it is for you to choose and make passive income this way. But let's say you don't want to do any of that. Well, if you head over to the copy trading tab, you can see that now we have not only our standard strategy, we also have the 0 DTE strategies. And guess what? This one is performing very, very well. I put 500 bucks right here. Now we have 36 users already copy trading from the strategy, and our monthly P&L for the last 30 days has been 9%. You can see I put 500 bucks and I already made 9%, and it's going to be 1 month tomorrow actually. So almost 10% in a single month, which is amazing, but it is also riskier than just the normal one, which gives us 27% a year. So 152% per year is very, very good, but it comes with its risks. So make sure you understand that before you jump into any of this. So if you like this kind of format where we go over stories of big traders or even small traders, just stories with options, just let me know in the comments and I can do more research on people who did something very stupid or people who were very, very profitable. If that's something that you would like to see here in the channel, just comment down below and you will see more of this. So hope you enjoyed. Don't forget to like, subscribe, and turn on notifications so YouTube can recommend these videos to other people. And if you can also share this video, it will help us a lot. But if you've done all of this already, thank you so much, and we'll catch you guys in the next video. Peace out.